A recession can create tremendous opportunity for you to start building some serious wealth. In this video, I will address a few concepts that you can use to build your wealth, and if you're already investing or trading the markets, how to maintain it throughout recessions. Uncertain economic times can be frightening. It's a time where there's a lot of uncertainty on the well-being of the market. It's characterized by a significant decrease in economic activity. People may experience a decrease in their income or their portfolio if they are already invested in the market. This can lead to financial stress and uncertainty. It is common that this leads to a negative mindset and a loss of confidence in the economy, which can lead to a sense of hopelessness and a lack of motivation. However, it can also lead to a shift in mindset towards being more economical and saving money. This can lead to a focus on financial planning and budgeting, which lays the foundation towards a healthy investment mindset. A common thing that you might hear often during turbulent economic times is that cash is king. Well, only a portion of this is accurate. While it is true that having cash at hand might create a financial buffer to cover expenses and living costs, leaving cash in the bank or under your mattress will cause it to depreciate over time. Our economy is inflationary, which means that products, goods, and services become more expensive over time. This means that today you could buy about 25 bags of groceries with $1,000 today in the United States. But because prices are increasing, it means that every year you will be able to buy less bags of groceries. So the longer you keep that money sitting in your bank account, the less bags of groceries you will actually be able to buy with that as time progresses. Instead, you could consider investing your money over a longer period of time. If done properly, this can help you preserve the value of what you already have and establish the groundwork for creating actual wealth in the future. And what if I told you that a downturn can really be a great moment to lay those foundations? One technique that I want to talk about is dollar cost averaging. Dollar cost averaging is an investment strategy in which an investor divides a larger sum of money into smaller, equal parts and invests them at regular intervals over time, regardless of the asset's current price. The idea behind this strategy is to reduce the risk of buying at a high price and to take advantage of market fluctuations by buying more shares when prices are low and fewer shares when prices are high by spreaded buys over time. What you will effectively do as you use this strategy is to invest a set amount of money every month, week, or day. You can even automate this on many investment platforms, making it a great strategy for beginners as well as for those who are looking to hold their investment over a longer period of time. Now, normally, this strategy is used as an all-round strategy, no matter what the economic conditions are. This means that often this strategy is used in rising markets as well as in declining markets. However, if you dissect this strategy and adjust it by only using this in downtrending markets instead, it means that with every investment you would make, your average price entry slides down with it. If you zoom out and look at the wider picture, you might just find yourself investing in a really lovely area when the downtrending market cycle ends. By using this method, you can avoid trying to predict when a market will bottom out exactly, which is very difficult to do, even for experienced investors. Keep in mind to use this strategy sensibly and only invest the money that you can afford to lose and don't need. If you're looking to get started, then it might actually be a good idea to start with small amounts that you feel comfortable with. And as you get more accustomed to it, then you can increase your periodic investments over time. Remember that the market moves in cycles as well. There will be times where the markets soar, and there will be times where the markets fall heavily. With this approach, it's crucial to keep an eye on the bigger picture and resist being influenced by short-term swings. If you are already invested in the market, then watch this video till the end, as you will learn what you can do to protect that which you have already invested. One thing you can do is hedging your investments. Hedging is a risk management strategy used to mitigate the potential negative impact of price fluctuations in an asset or an investment. In simple terms, hedging is a way to reduce risk of loss by taking a position that will benefit from the adverse market move. Hedging can be done in many different ways. In finance, for example, hedging is used by investors to reduce the risk of potential losses in their portfolio. This is done by taking positions in assets that are expected to move in the opposite direction of the portfolio's overall exposure. So, what does this mean in plain English? For example, an investor might hedge against the risk of a stock market decline by purchasing options or shorting an index, for example. And that leads me to the next concept, which is short selling. Short selling is also known as shorting or going short, and it means that you can borrow shares of an asset and then you can sell them on the open market with the expectation that the price will fall. In the event that this occurs, the short seller can then buy back the shares at a lower price and return them to the lender. The difference of the price will result in profit for the one that shorted the price higher. However, if the opposite happens and the price of an asset instead goes up, the short seller has to buy the shares back at a higher price, resulting in a loss. Now, what this really means is that if you are already exposed to the market, shorting the same asset can actually help you offset the original investments that you've already made. So let's say you have bought $1,000 of Bitcoin, for example, and you think that the market is going down. Instead of actually selling your positions that you have been riding for a while, and instead of selling those and reverting back to cash, you can short $1,000 worth of Bitcoin. This effectively pauses your investment without the need of closing out of your positions entirely. As long as you have offset your position, meaning that you are $1,000 long and $1,000 short, you will not really make any more money should the price increase, but much more importantly, you will not really lose any money if the price does turn down. When combining these techniques together, it can form a very powerful toolkit and lay the foundations of building true wealth that can be life-changing. Another thing that I believe is very, very vital, if not the most important of anything else, investing in education. Invest in education. Get yourself educated in the quieter times so that the next time when everything seems to be going to the moon, the markets are extremely volatile, they're roaring, you can actually keep a clear mindset and focus on what you wish to do, where you can rely on your own knowledge, experience, and information. It is important in the end to maintain a clear-headed overview, and if you keep your focus on the longer term, it will pay off eventually, regardless of the strategy that you're using. That is why you need to watch this video next, and if you enjoyed this video, don't forget to leave a like and subscribe for more videos and analysis on the markets.